Welcome back to the deep dive. Today, we are putting a very specific word under the microscope.
A very loaded word.
A very loaded word, yeah.
Yeah?
It's a word that, if I'm being honest, usually comes with a bit of a sneer attached to it. It conjures up these images of, shouting men in polyester suits on trading floors, bursting bubbles, maybe a villain in an Oliver Stone movie.
Or that guy at the party. We all know that guy.
Oh, that guy.
Yeah.
The guy who won't stop talking about crypto.
Exactly.
Exactly. We are talking about speculation.
It certainly carries a tremendous amount of cultural baggage.
It does. And usually when you hear someone called a speculator, it's not a compliment. It implies recklessness. It implies, gambling, greed, profiting off something without actually building anything.
Yeah.
But we've pulled together a stack of sources today. We've gone through the Wikipedia entry on speculation, historical accounts of market manias from way back in the 1600s, and some really heavy-hitting economic theories.
From the likes of Keynes and Graham.
Right. And they all suggest that the reality is, well, it's a lot more complicated.
It is. The central tension we're going to explore today is really a question about the architecture of our world.
How so?
Well, are speculators just reckless gamblers who cause financial crises and, chaos?
Oh.
Or are they actually the unsung essential heroes who keep the global economy from freezing up?
Okay, that is a massive claim. Heroes, really.
It's the argument.
Because my visceral reaction, and I think most people's, is no way. You think of the 2008 crash, you think of gas prices spiking.
Yeah.
You blame the speculators.
And that's the reputation, often for good reason. But we're going to try and look at the mechanics beneath the market movements. We're going to talk about tulips. We're going to talk about onions.
Onions.
Oh, yeah. Onions play a surprisingly large role in American legal history, and we're going to talk about human psychology.
I am still stuck on the onions, but okay, I'm sure we'll get there. So our mission today is to move beyond that pejorative definition and really unpack the machinery of risk, price, and value.
Let's do it.
So let's start with the basics. If we strip away all the emotion, all the baggage, what actually is speculation?
Well, if we look at the standard definition, the one used in finance and how our sources break it down, it's the purchase of an asset.
An asset, so that could be anything.
Anything. A commodity, like wheat, goods, real estate, stocks, you name it. But it's the purchase with the hope.
The hope, not the certainty.
Exactly. The hope that it will become more valuable in a brief amount of time.
Okay, so hope and brief. Those seem like the two key words there.
They're everything. And the most important distinction here is that the speculator is focusing purely on price movements. They aren't necessarily interested in the fundamental value.
You mean like if the company actually makes a good product?
Right, or the utility of the thing they're buying. They don't really want to own it, not in the traditional sense. They want to sort of rent the price movement.
Rent the price movement. I like that. So let's use a classic analogy to make this concrete. Buying a house.
Sure, perfect example.
If I buy a house because I want to live in it, raise a family, maybe plant a garden, that's utility.
Yes, that's consumption or a very long-term investment. You care if the roof leaks. You care about the school district.
Right. I'm buying the houseness of the house.
Correct. You're consuming the asset. But if you buy a house in a neighborhood because you read some blog post saying it's the next big thing.
And your plan is to just paint the front door red and flip it in 6 months for a 20% profit without ever moving in.
That is speculation. You don't care about the roof or the schools, not really. You care about the price trajectory. You're betting on the belief of the next buyer.
Got it. Okay, that makes sense. But the market isn't just made up of speculators and, homeowners. Our sources break down the financial markets into 4 primary characters. And I found this really helpful to visualize the ecosystem. It's like a cast of characters in a play.
It is. And this is crucial for understanding why the speculator exists. You can't understand the speculator without understanding who they're trading with.
Okay, so who's character number 1?
The first character is the hedger.
The hedger. This sounds like the cautious one. The responsible one.
They are the pragmatists. The hedger is someone who transacts to offset a pre-existing risk.
A pre-existing risk. What does that mean?
The classic example is a farmer. Let's say you grow corn. Your entire financial life is terrifying.
Right. Because you have all the costs up front, the seeds, the fertilizer, the diesel for the tractor.
Yeah.
But you have no idea what the price will be when you actually have the product to sell months later.
Exactly. You plant in April, you harvest in October. What if the price of corn crashes in September? You go bankrupt. You lose the farm. That is a massive, massive risk.
So what does the farmer do? How do they hedge?
So a hedger, the farmer in this case, might go into the market and sell a contract to deliver that corn at a fixed price later in the year.
So they lock in their price today.
They lock it in. They are hedging their bet. Now, they give up the chance of a massive windfall if corn prices were to suddenly skyrocket to $10 a bushel.
But they're safe.
They're safe. They've protected themselves against a crash down to $2. They are buying certainty in an uncertain world.
Okay, so hedger equals safety first. They're using the market to remove risk from their life. Who's character number 2?
Number 2 is the arbitrager.
The arbitrager. I always feel like I need a monocle and a top hat to say that word.
It sounds incredibly fancy, but the concept is actually very simple, very mechanical.
Okay.
The arbitrager just seeks to profit from price differences for the exact same item in different markets. It's all about spotting inefficiency.
So, like, an example.
Let's say gold is trading for $2,000 an ounce in London, and for some weird glitchy reason, it's trading for $2,005 in New York.
So the same exact bar of gold has 2 different price tags depending on where you're standing.
For a brief moment, yes. The arbitrager sees this instantly. Their computers see it. They buy it in London for $2,000 and instantly sell it in New York for $2,005.
Then they pocket the $5. That
Yeah.
feels like free money. Is it really that simple?
It's essentially risk-free profit, yes, but it requires incredible speed and technology. And here's the social value of what they do.
There's a social value.
Absolutely. By doing that trade, they actually help equalize the prices. Their buying pushes the London price up a tiny bit, and their selling pushes the New York price down a tiny bit until that $5 gap closes.
So they're like the market's referees. They keep the global market in sync. They enforce logic.
That's a great way to put it, yes.
Got it. Okay, so hedgers and arbitragers, number 3.
Number 3 is the investor. This is the one we're probably most familiar with. The long gamer.
The Warren Buffett type.
Exactly. The investor seeks profit through the long-term ownership of the instrument's underlying attributes.
So this is the person buying a stock because they believe the company makes good cars, or it's well-managed, or it pays a good dividend.
Precisely. They are looking at growth, earnings, yield. They plan to hold it for years, maybe decades. They treat the stock like they're owning a tiny piece of a business, not like a lottery ticket.
And finally, that brings us to character number 4, the star of our show today.
The speculator.
The speculator. So how do they fit in with these other 3?
Well, they're defined by what they're not. They don't have a crop to hedge. They aren't farmers.
Okay.
They aren't looking for those tiny microsecond price gaps like the arbitrager.
Right.
And they aren't necessarily married to the long-term success of the company like the investor. They trade purely to anticipate price movements. They are taking on risk voluntarily.
Voluntarily. That's a key word.
It is. They're taking on risk in exchange for potential profit.
So if we look at the flow of energy here, the hedger, the farmer, is desperately trying to get rid of risk. The speculator is voluntarily walking in and taking it.
That is the symbiotic relationship right there. And
Yeah.
this is the core of the argument for why speculation is necessary. You cannot have a hedger who wants to sell their risk unless you have a speculator on the other side willing to buy it.
We are definitely going to drill deep into that mechanism later, because that sounds like the heart of the hero argument.
It is.
But before we get there, I want to touch on something our sources mentioned about the fuzzy line. Because hearing those 4 definitions, it all sounds very neat and clean. But in reality, isn't the difference between an investor and a speculator a little subjective?
It is notoriously fuzzy. It's often a matter of time scale and self-perception. Even Benjamin Graham.
The father of value investing. Warren Buffett's mentor.
That's the one. He wrote about this in his famous book, The Intelligent Investor.
The Bible of investing, yeah. What was his take on it?
Well, he struggled with it. He tried to draw a line. He defined the defensive investor as someone interested chiefly in safety and, quote, freedom from bother.
Freedom from bother. I like that.
But even he admitted that some speculation is basically unavoidable. He said, essentially, that risk has to live somewhere. It must be assumed by someone.
Right. If you buy a stock, even if you plan to hold it for 10 years, there's no guarantee it goes up. I mean, huge companies have gone bankrupt. Kodak, General Motors. You're speculating on the future, to some degree, anytime you buy anything.
Exactly. Graham pointed out that even long-term buy-and-hold strategies can be classified as speculation unless your primary motivation is just income, like from dividends, or the safety of your principal. If you're secretly hoping the price doubles,
Which everyone is.
which everyone is, then there's a speculative element to what you're doing. It's a spectrum, not a binary switch.
And the regulatory bodies like the CFTC.
Right.
It's the Commodity Futures Trading Commission in the U.S.
Correct.
They have to have a stricter definition, right? They can't just go by vibes. They can't look at a trader and say, he looks like he's hoping a little too much today.
No, you can't regulate vibes. The CFTC keeps it very, very simple. For them, a speculator is a trader who does not hedge.
We'll stop.
Full stop. If you aren't a farmer protecting your crop or an airline protecting its future fuel costs, you are a speculator. It doesn't matter if you're grandma buying one share of AT&T or a massive hedge fund buying $1 billion of oil contracts. If you don't have a direct commercial interest in the physical underlying asset, you are, by definition, speculating.
Simple as that. Okay, so we know what they are. Now let's talk about where they came from. Because this isn't a modern invention. This isn't some crypto bro thing. People have been betting on prices since... Well, since we had prices.
For centuries. The sources really highlight the 17th century in the Netherlands as a major turning point.
The Dutch.
This is really where commodity markets as we know them were born. The Dutch were the absolute masters of trade. They invented the stock market, the central bank, and arguably the speculative bubble.
And you cannot talk about 17th century Dutch markets without talking about flowers.
Tulip Mania. 1634 to 1637.
This story never gets old. It's like the original sin of finance.
It is the archetype. It's the story everyone tells to warn about speculation. What's so fascinating is the mechanism behind it. The Dutch Calvinist society at the time had strictly banned gambling.
Okay, so no casinos.
No casinos, no betting on dice, so people needed an outlet for that risk-taking impulse.
Yeah.
And they turned to tulip bulbs.
Which seems so wholesome. Flowers. Until you realize people were trading their houses and their life savings for a single root.
For a single bulb. And specifically the most valuable ones were the broken bulbs. The ones with these beautiful fiery stripes, which we now know was actually caused by a virus infecting the bulb.
So they were paying a premium for a sick flower.
They were. But here's the technical innovation that really matters for our story. They were trading forward deals. Most of this frantic trading happened in the winter.
And why does the season matter so much?
Because in the winter, the bulbs are in the ground. They're dormant. You can't physically hand over the tulips. It doesn't exist yet, in a way.
So what were they trading?
They were trading pieces of paper, promises, contracts to deliver a specific tulip bulb in the spring. This was arguably the first widespread popular futures market.
So they were speculating on the future price of a flower that was currently buried in the frozen mud.
Exactly. The Dutch had a fantastic name for it. The wind handle.
The wind trade.
Literally the wind trade, because they were trading nothing but air and the turnover was incredibly rapid. The sources say in places like Haarlem and Amsterdam, people would meet in taverns.
Not on some fancy exchange floor.
No, in a pub. And these paper contracts would change hands 10 times a day.
So I buy the paper from you for 100 guilders. I turn around and sell it to the guy at the next table for 110. He sells it to his friend for 120. And the actual bulb hasn't moved an inch from under the snow.
Precisely. And we all know how that story ended. In February 1637, the music stopped. Someone tried to sell, and for the first time, no one wanted to buy. Prices collapsed 90%, 95% in a matter of days.
A spectacular crash. But it didn't stop there. That wasn't the last bubble. The 18th century saw even bigger disasters, right?
Oh, yes. The 1720s were a particularly bad decade for Europe. You had the South Sea bubble in England and the Mississippi Company in France, and they both collapsed at almost the exact same time, around 1720.
Now, these were massive corporate disasters, right? These weren't just flowers in a tavern. These were huge companies backed by the government.
They were enormous. The South Sea Company was supposed to hold the monopoly on all trade with South America. Everyone invested, from the general public to the highest levels of government, even Sir Isaac Newton.
Isaac Newton, the smartest man alive, the guy who invented calculus and figured out gravity.
He lost a fortune, a life-changing amount of money. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people."
Wow.
And these events, the South Sea and Mississippi collapses, were so devastating that they brought the entire concept of speculation into disrepute in Europe for generations. It became a dirty word. It was seen as a moral failing, not just a financial one.
But it didn't disappear. It just evolved.
Yeah.
And our sources point to a specific year, 1867, as a major technological shift, a moment that changed speculation from a sort of tavern activity into a global obsession. What happened in 1867?
The invention of the stock ticker machine in New York.
Ah, the ticker tape. That little chattering strip of paper you see in old movies.
It seems so quaint now, doesn't it? But this was the internet of its day. It was a revolution.
How so? What did it change?
Well, before the ticker, if you wanted to know the price of a stock or if you wanted to trade, you generally had to be physically present at the exchange. Or you had to have a messenger boy running back and forth.
So information traveled at the speed of a running child.
Exactly. It was slow, it was exclusive, it was an insider's game. The ticker changed all of that.
It democratized it.
It democratized speculation. Suddenly, you could be in a broker's office miles away, or eventually in other cities, and see the price almost in real time. It made the market a spectator sport for the entire country. It removed the need to be on the floor.
And I assume this just exploded the number of people who were doing it.
Significantly. The sources give us a truly staggering data point on this. In the year 1900, there were about 4.4 million shareholders in the United States.
Okay.
By 1932, just over 30 years later, that number had jumped to 26 million.
Wow. From 4 to 26 million. So the ticker tape turned the market from an exclusive club into a national obsession.
Precisely. And that brings us right back to the core conflict. As speculation grew, as it moved from the tavern to the living room, so did this huge debate. Is this good or is this bad for society?
Okay, let's play defense attorney first. Let's look at the argument for the speculator as hero. This sounds incredibly provocative, especially after talking about the wind trade and Isaac Newton losing his shirt.
It is a view championed by economists like Nicholas Kaldor and the famous trader Victor Niederhofer. Their core argument is deeply counterintuitive.
Which is?
They claim that speculators actually stabilize prices rather than disrupt them.
Okay, you have to walk me through that, because when I think speculator, I think volatility. I think prices jumping up and down like crazy because of rumors and panic. How on earth do they stabilize things?
They do it through something called the sustainable consumption theory. Let's look at two scenarios to explain it. Scenario A, a shortage.
Okay, let's say the wheat harvest is terrible this year. There's a drought in the Midwest. There's not enough wheat to go around for everyone.
Right. Now, a speculator who studies this stuff for a living looks at the weather reports, sees the satellite data, and realizes the harvest is going to be bad before the general public knows. So what do?
They start buying wheat now, betting the price will be higher later.
Exactly. Which drives the price up immediately.
Right. And people get angry. They say, look at those greedy speculators in Chicago making bread more expensive for my family.
Yes, that's the immediate reaction. But ask yourself, what happens when the price of bread goes up?
Well, basic economics. People buy less of it. They conserve. Maybe a bakery bakes slightly smaller loaves, or families don't throw away the crusts. You make it last.
You make it last. High prices force conservation. So that limited supply of wheat is consumed more slowly. It gets stretched out over the year. If the price had stayed artificially low because there were no speculators forcing it up early, people would have eaten through the supply at a normal rate, and suddenly, in the middle of winter, there'd be zero wheat left. That's a famine.
So the speculator, by raising the price early, essentially forces society to ration the scarce supply so it doesn't run out completely.
Correct. And there's a second effect. That high price sends a massive signal to other producers all over the world. It's like a bat signal.
A bat signal for wheat.
It says, hey, wheat is really expensive, grow more. Or if you're in Argentina and have a surplus, import it to the U.S. It encourages new supply to come into the market to meet the demand.
That is actually a really compelling argument. It's like the aha moment. The high prices we hate during a shortage are actually a survival mechanism.
That's the theory. Now let's look at scenario B really quickly. A surplus. Let's say the harvest is massive, the silos are overflowing, the price is too high compared to this new reality.
So the speculator sees this and bets the price will go down. They sell.
They sell, which pushes the price down. And what do low prices do? They encourage people to buy more, to consume more, to export more. It helps clear the surplus so it doesn't all rot in the fields.
So in this view, the speculator is just a really aggressive, really fast mechanism for finding the right price faster than anyone else.
That is the argument. They process information, weather, politics, shipping data, and they translate it into price. This is called price discovery. Without them, the price might be wrong for months, leading to huge misallocations of resources.
Let's talk about another benefit the defense brings up. Liquidity. The outline mentions the pork belly example. I love that we're jumping from tulips and wheat to bacon.
This is a classic, simple way to explain liquidity. Imagine a market for pork bellies, which is, bacon, where the only participants are farmers who raise the pigs and butchers who sell the bacon.
Okay, no speculators allowed, just the makers and the users. Yeah. Pure utility. What's wrong with that?
The problem is timing. The farmer wants to sell when the pigs are ready, let's say on a Tuesday at 10 a.m. But the butcher wants to buy when his inventory is running low, which might be on a Thursday at 2 p.m.
Their needs don't line up.
They don't line up. And even if they happen to meet at the same time, the farmer might want to sell for $5 a pound, and the butcher only wants to pay $3.
And since there's nobody else around, no deal.
Exactly. Because there are so few of them, the gap between what the farmer wants to sell for and what the butcher wants to pay, that's called the bid-ask spread, it might be huge. Without speculators, the market is illiquid. It's hard to do a deal. You might be stuck with your pigs.
So enter the speculator.
The speculator fills that gap. They provide a constant presence in the market. They are willing to buy from the farmer on Tuesday at 10 a.m., hold the risk for 2 days, and sell to the butcher on Thursday. They provide capital. They narrow that spread. They ensure that if you want to sell, there's always someone there to buy instantly. And if you want to buy, there's someone there to sell. That is liquidity.
So they're the grease in the gears. They make sure the whole machine doesn't just grind to a halt.
That's a perfect way to describe it. A liquid market is a safer, more efficient market for everyone else who uses it.
And then there's the risk-bearing aspect. We touched on this with the farmer earlier, but I want to make sure we really nail this down, because this is arguably their most important social function.
It absolutely is. Let's go back to the farmer in the corn scenario. Let's really look at the psychology of that farmer. He is terrified. He has loans to pay for his tractor, for his land. If the price of corn drops to $2 a bushel, he loses everything.
So in the face of that risk, he might just choose not to plant at all. He might say, it's too risky this year, I'll just leave the field empty, which is bad for everyone because, we all like to eat.
Exactly. Society needs the corn. So a speculator steps in, maybe a guy in Chicago who has never seen a corn stalk in his life, and he says to the farmer, I will sign a contract today to buy all of your corn in October for $4 a bushel.
Now, the speculator's taking a massive gamble. If the price of corn drops to $2 by October, the speculator has to buy it for $4 and loses a ton of money.
Yes. The speculator takes the blow to the face. But the farmer...
The farmer is safe.
The farmer is safe. He is hedged. He can go to the bank, show them the contract, get a loan for his seeds. He plants the corn, production increases. The speculator effectively acts as an insurance company for the producer.
When you put it that way, it does sound heroic. I mean, someone has to hold the hot potato of risk.
Yeah.
And the speculator is the one who says, throw it to me.
Throw it to me. I think I can handle it. Now, sometimes they can't and they go bust, but the key is that the farmer, the producer, survives.
Okay, there's one more argument for the defense, and it's a controversial one. It involves shorting.
Ah, yes, shorting. Betting against a company. Betting the price will go down. This is usually seen as the ultimate villain move. People say, you want American business to fail.
It's often vilified, yeah. But you're saying there's a social good here.
A huge one. Hedge funds that specialize in shorting can act as the canary in the coal mine for the entire economy.
How so?
Because they have a direct financial incentive to find the rot. Think about it. Everyone else, the company CEO, the investment bankers selling the stock, the traditional investors who own it, everyone is incentivized to be optimistic.
It's an echo chamber of positivity. Everything's great. Buy more.
Exactly. The short sellers are the only ones who get paid to be pessimists. They're the ones digging through the footnotes of financial reports, looking for off-balance sheet exposures, hidden debts, environmental liabilities, or just plain old unsustainable business practices.
Like the guys who spotted the housing bubble in The Big Short, or the people who exposed the frauds at Enron.
Or Wirecard in Germany more recently. By betting against these bad companies, they can expose fraud or weakness far earlier than the regulators might. They can stop unsustainable practices by crushing the stock price before the bubble gets even bigger and hurts even more people when it finally pops.
So they're the market's detectives, or maybe bounty hunters, funded by their own greed.
Ideally, yes. That's the argument.
Okay, so that's a powerful case for the defense. Speculators stabilize prices, they provide liquidity, they bear risk, and they expose fraud. But it's time to bring in the prosecution, because we know it's not all sunshine and stable corn prices.
No, it is not. If the defense's case is built on efficiency, the prosecution's case is built on chaos. And it rests its case on two main pillars, something called the winner's curse and, of course, the devastating nature of bubbles.
Okay, let's start with the winner's curse. That sounds like a bad game show prize.
It usually applies to auctions, but the principle is the same. Imagine we're auctioning off a big jar of coins. No one knows exactly how much money is inside. Everyone in the room gets to write down a guess, a bid.
Okay.
The person who wins the auction, the person with the highest bid, is almost by definition the person who guessed the highest number.
Right.
Which means they were very likely the most overly optimistic person in the room. They probably bid more than the jar is actually worth. So by winning the auction, they've actually lost money.
So the speculator who wins the trade, who manages to buy the stock at its absolute peak, is often the one who is the most wrong about its value.
Exactly. This concept suggests that speculation doesn't attract the smartest, most rational actors, but instead the most irrational, overconfident ones. And when you get enough of those irrational people together in one market,
You get a bubble.
you get an economic bubble. This is where the real social harm comes in. The definition of a bubble is simple. It's when the price of an asset exceeds its intrinsic value by a significant margin.
And this is where the social epidemic concept from our sources comes into play. It's not about fundamentals anymore.
Not at all. It becomes a feedback loop, a social virus. The price starts to rise and that attracts media attention. New, less informed buyers enter the market simply because they see the price rising. Their buying pushes the price up even more. It generates more stories and attracts even more buyers. It feeds on itself. It's driven by word of mouth and the fear of missing out. FOMO. And the argument here is that speculators are the ones who fuel this fire. They pour gasoline on it. They do. While the defense says speculators stabilize prices based on hard information, the prosecution argues that in a bubble, speculators often ignore information and just follow the crowd. They engage in herd behavior. They see the price going up, so they buy, which makes it go up more. This creates artificial volatility.
So instead of helping the market find the real price, they're helping it create a fantasy price.
A fantasy price that is completely detached from reality until inevitably it collapses. And when it collapses, like in 1929 or the dot-com bust or 2008, it hurts everyone. It doesn't just wipe out the speculators. It destroys pensions. It destroys jobs. It freezes up credit for small businesses.
Yeah.
The innocent bystanders get hit by the shrapnel.
There's a famous quote about this from John Maynard Keynes. He seems to be the central figure in this entire debate on both sides.
Keynes is absolutely fascinating here. In his 1936 masterpiece, The General Theory, he wrote what might be the most famous line ever about this.
What was it?
Speculators may do no harm as bubbles on a steady stream of enterprise. But the situation is serious when enterprise becomes the bubble on a whirlpool of speculation.
When enterprise becomes the bubble on a whirlpool of speculation. That is a poetic way to put it.
It's beautiful, isn't it? He was warning about what happens when the act of speculation, the casino, dominates the actual business of doing business. When Wall Street becomes more important than Main Street, when the tail wags the dog.
But here is where it gets really, really interesting. And this is what I call the Keynes paradox. Because listening to that quote, you'd think Keynes was some stuffy ivory tower academic who hated traders and thought they were all villains.
Not at all. Keynes was a player. He was, and I say this with respect, a degenerate gambler in the best possible sense. He personally ran a precursor to a hedge fund. It's called the Chest Fund for King's College, Cambridge.
So the guy who wrote the most famous warning about the whirlpool was swimming in it every day.
And he was an Olympic-level swimmer. His fund averaged a 13% profit per year.
13%. That's great even today.
It's phenomenal today. Now remember, he was doing this during the Great Depression. The global markets were being absolutely decimated, and he was cranking out double-digit returns year after year.
That's incredible performance. How on earth did he do it?
He was basically inventing modern portfolio theory on the fly. He didn't just buy and hold British stocks. He diversified. He bought commodities, he traded currencies, he bought U.S. stocks, which was considered a risky emerging market back then, and he shorted the market.
He shorted. The very thing people call unpatriotic.
Oh, yeah. He sold borrowed stocks to profit from market falls. He was constantly looking for what he called opposed risks. So the harshest critic of the whirlpool was actually a master of using speculation to secure the financial future of his college.
That adds such a layer of nuance. It's not speculation is bad. It's more like speculation is powerful and dangerous, so you better know what you're doing.
Exactly. He respected the beast because he had tamed it.
This brings us perfectly to the referee, the government. If speculation is this double-edged sword, essential for liquidity but dangerous for creating bubbles, How have governments tried to manage it over the years? It seems like a nightmare to regulate.
It has been a game of whack-a-mole for 300 years, and we're still playing it.
We mentioned the Bubble Act of 1720 earlier, after the South Sea Bubble.
Right, passed in the UK at the absolute height of the panic. It was designed to stop speculative schemes. And amazingly, it stayed on the books for over 100 years until 1825. They basically tried to ban the formation of new joint stock companies without a royal charter.
That is a long time to hold a grudge against financial innovation.
Then you jump forward to the US. The next big one is the Glass-Steagall Act, passed in 1933 in the depths of the Great Depression.
Right. And that separated commercial banking, your deposits, your mortgage, the safe money, from investment banking, which was the trading and the gambling.
Exactly. The idea was to build a firewall. And that act was, as you know, largely repealed in the 80s and 90s, which many people argue set the stage for the 2008 financial crisis.
Yeah, but let's look at an even more extreme view. The Soviet Union.
Oh, I can imagine they didn't look too kindly on speculators. That's putting it mildly. Article 154 of the Penal Code of the USSR. Speculation, which they defined as pretty much any private trade for profit, was a criminal offense.
Criminal, like go to jail criminal.
Go to jail, pay a fine, or be sentenced to corrective labor. In the Soviet view, buying low and selling high wasn't providing liquidity or price discovery. It was parasitic. It was exploitation. You were adding no value to the product, just extracting wealth from the worker and the state.
That is the ultimate prosecution argument written into law.
It is.
But in the U.S., we have a very specific and frankly very weird example of regulation that I need to hear more about, the Onion Futures Act.
This is one of the oddest, most specific carve-outs in all of financial law. And it's a true story.
Okay, lay it on me.
In the mid-1950s, a pair of speculators in Chicago, one of them was a farmer-turned-trader named Vincent Kosuga, essentially cornered the market on onions.
Cornered the market. That means they bought all the available onions.
They bought up so many of the futures contracts that they effectively controlled the entire national supply. First, they drove the price way up. Then, they secretly built up a massive short position, betting the price would fall. And then they flooded the market with all their physical onions to deliberately crash the price. They made a fortune on the way up and a second fortune on the way down.
And what happened to the actual onion farmers?
They were devastated, completely wiped out. The price of a 50-pound bag of onions dropped to something like 10 cents. The physical bags themselves cost more than the onions inside them. Farmers were literally dumping truckloads of onions into the Chicago River because they couldn't even afford to transport them.
That is brutal.
The public outcry was deafening. The farmers marched on Washington, and Congress passed the Onion Futures Act in 1958. It specifically banned the trading of futures contracts on onions.
Just onions, not potatoes or carrots.
Specifically onions. To this day, you can trade futures on corn, oil, gold, pork bellies, weather patterns, almost anything, but not onions. And that law is still in effect.
That is wild. It's like a legislative monument to a single speculative disaster, a never forget for the onion farmers of the 50s.
Moving to the modern era, the next big regulatory push came after 2008 with the Dodd-Frank Act. This introduced a whole new set of attempts to rein in the beast.
What were they trying to fix this time?
A lot of things, but one of the big targets was excessive speculation, particularly in commodities. The CFTC proposed something called position limits.
Position limits.
It's basically a rule saying you, Mr. Hedge Fund, cannot hold more than X% of the world's supply of oil or wheat or copper.
So you're limiting how big any single whale can be in the market. So no one can do a Vincent Kosuga with oil and corner the market again.
That's the idea. And then you also have the Volcker Rule, which was part of Dodd-Frank. That rule bans banks from making speculative investments with their own money. It's called proprietary trading, if it doesn't benefit their customers. The argument was that big banks were gambling with the house's money, which was implicitly backed by federally insured deposits. When they won, they kept the profits. When they lost big, the taxpayers had to bail them out.
Which seemed like a pretty reasonable rule. If you want to speculate, use your own cash, not the insured deposits of grandmas and school teachers.
That's the logic. There have also been other proposals that never quite made it into law, but they're always being discussed, especially during crises, like the Tobin tax.
Right, that's a small tax on financial transactions.
Yes, a tiny tax, maybe 0.1% on every single currency trade. The idea is to throw some sand in the gears of the machine. It wouldn't hurt a long-term investor who buys something once a year, but it would make that high-frequency, purely speculative trading much less profitable. It's designed to slow down the whirlpool.
And there were even serious talks of banning oil speculation altogether.
In 2008, when oil prices spiked to $147 a barrel, German leaders, among others, proposed a worldwide ban on oil trading by speculators. They blamed hedge funds directly for the high gas prices people were paying at the pump.
But, going back to our hero defense,
Mm.
if you ban speculators from the oil market, who takes the risk from the airlines and the oil producers?
That is the trillion-dollar counter-argument. If you ban the speculators, the oil producers who need to sell and the airlines who need to buy have no one to trade with, the market freezes. The price might not be $147, but you might not be able to buy oil at any price. The liquidity vanishes.
It really seems like we are constantly trying to find this impossible Goldilocks zone. We want the liquidity and the risk-bearing, but we don't want the bubbles and the crashes.
It is the eternal struggle of financial regulation. You need the grease for the gears, but you don't want the grease to catch on fire and burn the whole factory down. And finding that perfect balance is incredibly difficult, partly because the market is always evolving faster than the laws can keep up.
So let's try to bring all of this together. We've gone from tulip bulbs in the frozen Dutch mud to high-frequency trading algorithms in New York data centers. We've seen that speculators can be the villains who corner the onion market, but they're also the silent partners who allow a farmer to sleep at night by buying his risk.
It's a duality. You really can't separate the two functions. The so-called intelligence of the market relies on having all these diverse actors with different motives. You need the safety-seeking investor, the pragmatic hedger, the opportunistic arbitrager, and the risk-taking speculator.
If you remove one leg from that four-legged stool, the whole thing just falls over.
Precisely. The speculator is the immune system of the market in some ways, and the virus in others. It's both.
I want to leave our listeners with a final thought experiment on that. We so often talk about reducing risk in the economy. We hate uncertainty. But imagine we got what we wished for. Imagine a world where all speculation was successfully banned tomorrow. No one is allowed to buy anything unless they intend to keep it for 10 years or consume it immediately.
It sounds safe, it sounds stable, it sounds prudent.
It sounds safe on the surface,
Yeah.
but is it? If I'm that farmer and I can't sell my corn futures to a speculator, I might not plant the corn. If I'm an airline and I can't hedge my fuel costs, I might have to cancel flights or raise prices unpredictably.
And if you just want to sell your house because you got a new job in a different city, but there are no speculators or investors allowed to buy it, you might have to wait 3 years to find a perfect buyer who wants to live in that specific house. You're stuck. The entire system becomes rigid.
So the provocative thought is this. Is the gambler, the character we culturally look down on, actually the very glue holding our entire secure world together? Is their willingness to take a risk the foundation of your safety?
That is the paradox at the heart of it all. We may not like them, we may sneer at them, but we might just need them more than we know.
Something to think about the next time you see a headline about Wall Street. Thanks for diving in with us.
Thank you. It was a pleasure.
We'll see you on the next Deep Dive.